Hi, I'm Emma Everett and I oversee our buyers agency team here at Momentum Wealth, and I'm joined by Kayla Merrick, team leader for our finance brokers, to discuss the recent findings from our property investor survey. Thanks for joining me, Kayla.
Thanks, Emma.
Our first key finding is that Perth and Brisbane emerged as the two most popular cities for investors with their intentions to invest in 2019. Now that's not too surprising, given the recent run-up and then cool down of the Sydney and Melbourne markets. Perth and Brisbane are at similar points of the property cycle. Brisbane has already started to achieve some price growth, where in Perth we're seeing rental market recovery and some increased buyer competition in the inner ring suburbs, leading to and pointing to a future market recovery.
Probably important to note also, Emma, that both Perth and Brisbane are offering similar levels of affordability in terms of price to income ratio, definitely in comparison to Sydney and Melbourne. So CoreLogic Stats released figures last year which indicated that you needed 8 to 9 times the average income to purchase a property in Sydney or Melbourne, whereas Perth or Brisbane was only 6 times.
It's interesting that you say that, Callum. Certainly, while Perth was the favoured city overall from our respondents, for investors located in New South Wales or Victoria, they preferred Brisbane over Perth as their next investment. Not surprising, considering how easy it is to fly up to Brisbane for a day and check things out. What's interesting about that for investors is that while there are similarities between the Perth and Brisbane markets, they're quite different and they offer different opportunities. The town planning schemes and the price points for development sites, for example, the spots on the property cycle, as we've mentioned, price points for different styles of properties, and even the contract and negotiation process is a little bit different between the two cities. So it's a good opportunity for New South Wales and Victoria investors to take a step back, perhaps investigate each option fully before they commit too early to one over the other.
Another key finding is that loan reviews are significantly on the rise. So I guess not surprising with the current goings on in the market. Not only the lending restrictions, borrowers are probably finding it more difficult to obtain finance. Obviously the big one, the Banking Royal Commission as well. Just to give an example, I guess a lot of people are probably experiencing that 2 to 3 years ago they were able to go to their lender, apply for a loan pretty easily, and were able to borrow up to a certain amount to allow them to achieve what they needed to. Compare that to today, it's definitely not as easy, and people are probably finding that they're not being able to borrow as much as well. So I guess another thing that's going to trigger a loan review is the bank increasing their interest rate. So we've seen a lot of that recently as well, and whilst the cash rate hasn't moved at all for quite a long time now, the banks have started increasing their rates. And I guess to put an answer as to why, what the banks are telling us anyway is that it's due to the wholesale funding costs. So they're having to pass that on to their borrowers to maintain their profit margins essentially.
Something else we're noticing, Calum, is that as investors grapple with the changing lending environment, it might mean a change in property strategy. Perhaps they had purchased a development site with plans to develop it in the future, or they might have had a strategy around the number of properties they were going to own or how long they were going to hold those properties. And now that strategy might not be achievable because of their access to finance. How should investors navigate those changes?
Well, I guess the best thing to do is, given the complexity of the environment at the moment, is to align yourself with a broker who understands what's going on, but more importantly understands your current situation and what those long-term goals are. If they're aware of that, they're able to then recommend not only a lender but also a product that's going to suit that, and you're going to have better chance of success.
Sounds like great advice. In the survey findings, we also noticed that over 60% of investors hold negatively geared property portfolios. So given that negative gearing has been in the news recently, with different parties proposing different approaches to this, we thought it would be worth a mention. Now, of course, it's important to note that should there be a change to negative gearing policy, it won't be retrospective. So for those investors that have responded, their property strategy doesn't need to change in the short term. It will, however, affect the next properties that they purchase, and so they'll want to take that into consideration. It's also important to remember that the tax offsets are just one part of a property's return. And so while it is an extra cost on investors, and it might drive the selection of the properties you choose, it doesn't need to be the difference between investing or not. Now, Calum, can you tell us what should investors be aware of from a finance or lending perspective with this issue?
Yeah, it's hard to, I guess, say, but one thing they may need to consider is that, I guess at the moment, the way banks are assessing loans for investors who either buy an investment property or maybe hold a few in their portfolio currently, is the negative gearing benefit that the lenders give. So that affects borrowing capacity. That gives a bit of a increase to what they can borrow. Now, if these changes come about and the lenders decide that they want to remove that, that's obviously going to affect borrowers' borrowing capacity. So that's probably the big thing that they should probably consider.
Something else that we've noticed is, and of course these policies go through a lot of changes before they're implemented, but in Labor's proposed policy, the negative gearing on a residential property can be offset against other investment income. So for some investors, another strategy might be to look for another investment, for example, like a commercial investment, which is a positively yielding investment, to offset the tax loss in the other parts of their portfolio. And that leads us nicely to our next key finding.
And our final key finding is that pooled investments are gaining traction. So I guess traditionally speaking, commercial properties, large-scale development projects generally haven't been typically accessible to a standalone investor from a financial perspective, whereby syndicates can provide access to these types of asset classes.
Absolutely. And there's a couple of great opportunities for investors here. One is that by pooling with a group of investors, they can access a far better quality investment than they could do on their own in these asset classes. We are seeing a renewed interest in cash flow by investors and their advisors, and so this also offers an opportunity to get away from a mortgage holding investment and put some money into something that's bringing them an income or offering them profit down the track. So in this current market with changes and lending restrictions, anything that gives investors more choices about how they invest and access to more parts of the market is a great opportunity. Thanks for joining us, everyone. I hope you've enjoyed hearing more about our key findings. To download the report or to learn more about how you can move forward with your property portfolio, just visit us at momentumwealth.com.au.